Do not let the silence fool you. Right now, the financial markets are closed. The ticker tape has stopped. The screens are black. The price of silver is frozen at $71.47. It feels peaceful. It feels like the world is taking a break for the new year. But under the surface, the pressure is building to a level we have never seen before. We are currently in the eye of the storm. Tonight, at 6:00 p.m. Eastern Time, the electronic futures market will reopen. And when that switch flips, the capital that has been waiting on the sidelines for the last 2 weeks is going to flood into the room all at once. We are not just starting a new trading day, we are starting a new trading year. And in the world of institutional finance, the first week of the year is the most violent, explosive, and profitable week on the calendar. It is called the January effect. It is a mechanical phenomenon where hundreds of billions of dollars of pension fund money, insurance capital, and hedge fund assets are forced to enter the market to rebalance their portfolios. And this year, they have a massive problem. Their computer models are telling them to buy the best performing asset of 2025. That asset is silver. But there is no silver for them to buy. The vaults are empty. The dealers are sold out. The miners are hoarding. So when that $50 billion wave hits the market tonight, it isn't going to flow gently. It is going to hit a brick wall of scarcity. In this massive market investigation, we are going to prepare you for the opening bell of 2026. We are going to explain the mechanics of the pension fund panic. We are going to show you why the banks, who smashed the price on New Year's Eve, are about to flip their strategy and chase the price higher starting tonight. And I am going to give you the battle plan for the next 48 hours. The countdown has started. The money is queued up and the price is about to move. This is the story of the January squeeze. But to understand why tonight is so critical, you have to understand how the plumbing of Wall Street works. Retail investors trade based on feelings. Institutional investors trade based on dates. And the most important date on the calendar just passed. Comment, I am ready, if you are watching the open with me. Let's analyze the wave. To understand the violence of this move, you have to understand the calendar of a banker. Up until midnight last night, the game was about defense. December is for selling. Fund managers sell their winners to lock in bonuses. Banks sell assets to lower their risk scores for the regulators. Taxpayers sell losers to harvest deductions. The entire pressure of December is selling pressure. But the moment the clock struck midnight and the calendar turned to January 1st, the game flipped to offense. The tax year is over. The selling pressure is gone. Now, the new allocations kick in. Every major pension fund and endowment has a target allocation for the new year. They might say, we want to own 2% commodities and to fund gold. Right now, because they sold everything in December, they own 0. So they have to go from 0% to 5%, and they have to do it fast. They usually execute these massive orders in the first 5 trading days of January. This creates a massive, artificial wave of buying demand that has nothing to do with news and everything to do with asset allocation. It is a wall of money that hits the market like a tsunami. And this year, the tsunami is bigger than ever. Why? Because in 2025, bonds collapsed and stocks were volatile. Silver was the only thing that worked. So the model portfolios, the computer programs that tell bankers what to buy, are screaming one word: silver. They are mandated to buy. They have no choice. And they are about to try and squeeze their elephant-sized orders through the mouse hole of the silver futures market. Let's put a scary number on this. The global pension system manages roughly $50 trillion. If they decide to move just 0.1% of their assets into silver to chase the performance, that is $50 billion of new buying. Now, look at the size of the silver market. The entire annual mine production of the planet is about 800 million ounces. At $71 an ounce, that is worth roughly $56 billion. Do you see the math problem? The pension funds want to buy almost the entire annual supply of the planet in the first week of January. It doesn't fit. You cannot buy $50 billion of silver at $70. There isn't enough metal. So, what happens? Fluid dynamics. When you pour a gallon of water into a shot glass, it overflows. The price must act as the rationing mechanism. The price has to rise until that $50 billion buys a smaller amount of metal. If silver goes to $140, that $50 billion only buys half the supply. This is why the banks are about to panic. They see the wave coming. Now, we have to talk about the villains of this story, the bullion banks. In yesterday's video, I explained why they smashed the price down to $70.50 on New Year's Eve. It had nothing to do with the value of silver. It was about regulations. They had to lower their GSIB risk scores for the year-end regulatory snapshot. They had to clean up their books so they could get their bonuses. They achieved their goal. The regulators took the picture and left the room. But today is a new year, and the banks are mercenaries. The banks aren't stupid. They have the best data on the planet. They see the same pension fund wave coming that I just told you about. They know the flow is coming on Friday morning. So, do you think the trading desks at JP Morgan and Goldman Sachs are going to stay short in front of that freight train? Absolutely not. They are going to do what they always do. They are going to front run their own clients. This is how the game is played. JP Morgan knows that the California Teachers Pension Fund must buy silver tomorrow morning. So what does the JP Morgan trader do? He buys silver tonight at the 6 p.m. open. He buys it at $72. Then, tomorrow morning, when the pension fund calls and says, we need $1 billion of silver, the JP Morgan trader says, sure, I have some right here. For $75, they scalp the market. They use their own capital to buy ahead of the mandated wave. This means the banks, the biggest sellers of December 2025, will likely be the biggest buyers of the first 48 hours of 2026. They are flipping the switch. The suppressor becomes a squeezer. Why? Because they want to ride the wave up before they try to short it again later. This aligns all the major forces in the market for the first time in years. The East is buying, the pension funds are buying, and now the banks are buying. Who is selling? Nobody. This is the recipe for a vertical move in the paper market. But the paper market is only half the story. While the screens were black today, the real world was still screaming shortage. The countdown is ticking. We are hours away from the first trade of 2026. If you look at the chart right now, you see the number $71.47. That number is flashing on screens in Tokyo, London, and New York. It is the number the algorithms use to value billions of dollars of derivatives. But I have to tell you something that the bankers won't admit. That price is a lie. It is a phantom price. It is the price of a digital contract traded on a holiday week with thin volume. If you try to take $71.47 into the real world and exchange it for an ounce of physical silver, you will be laughed out of the room. The paper market is currently living in a fantasy land. The physical market is living in a supply crisis. While the hedge funds were selling paper to lower their taxes, the retail public was storming the coin shops. We have received reports from major bullion dealers across the US and Europe. They are reporting a complete blowout of inventory. Usually, the week between Christmas and New Year is dead quiet. But this year, sales volume was up 300% compared to last year. Why? Because the public smells the fear. They saw the volatility, they saw the debt headlines, and they decided to take possession. But here is the problem. The dealers cannot restock. The sovereign mints, US Mint, Royal Canadian Mint, are closed for the holidays. The wholesalers are running on skeleton crews. So every ounce bought this week is an ounce that cannot be replaced until mid-January. The shelves are bare. So what did the dealers do? Did they lower the price to match the drop in the spot market? No. They raised the price. If you look at the premium on a Silver Eagle right now, it is approaching $20 over spot. The ask price is over $90. This is the market telling you the truth. The spot price says silver is abundant. The premium says silver is extinct. This divergence is the most reliable signal in commodities. When the paper price drops, but the physical price rises, it means the paper market is broken. It means the shorts are trying to hold a beach ball underwater. And when the paper market finally breaks, which begins tonight, it snaps up to meet the physical price. It doesn't meet in the middle, it gaps up. But the shortage isn't just happening at the coin shop, it is happening at the source, thanks to a massive drain moving from west to east. We cannot talk about physical silver without talking about China. While New York sleeps, Shanghai eats. The price in China is still trading at a massive premium to the west. We are looking at a gap of nearly 5 per ounce. And here is the critical news. While New York was closed for the holiday, China implemented new silver export controls, effectively locking their doors. They are trapping the metal inside the country while Wall Street is still trying to find the keys to the vault. This arbitrage is the engine of the shortage. Every day that New York trades lower than Shanghai, a fleet of airplanes takes off from JFK and Heathrow carrying silver bars to the east. This is not a conspiracy. It is simple math. If you can buy an iPhone for $500 in New York and sell it for $600 in Shanghai, you buy every iPhone in New York. That is exactly what is happening to 1,000-ounce bars. The West is being drained of its strategic reserve. We are selling our heritage for paper dollars, and China is happily taking it. They know that in 2026, the paper game ends. They want to be holding the physical chips when the music stops. This flow of metal creates a hard floor under the price. The price cannot drop below the level where arbitrage becomes profitable. Right now, that floor is roughly 71. If silver drops below $71, the Chinese buyers back up the truck. They act as the buyer of last resort. This limits the downside risk for you. You aren't just betting on a chart, you are investing alongside a superpower that wants to corner the market. But wait, the skeptics say, if the price is $70, the miners will just dig more. No, they won't. We are facing a supply cliff. It takes 10 years to open a new mine. Even at $100 an ounce, you cannot speed up the geology, you cannot speed up the permits. And right now, governments in Mexico and Peru are attacking the miners with higher taxes and threats of nationalization. So precisely when the world needs more silver, the political environment is ensuring we get less. The dealers are empty, the industry is panicking, the East is draining the West, the setup is perfect, but analysis is useless without execution. Now, I'm going to give you the battle plan, the specific targets to watch for when the bell rings. We have reached the final chapter. We have dissected the $50 billion wall of capital. We have exposed the dealer blackout. We have analyzed the insider flip. Now, the analysis stops and the execution begins. You have the why. Now you need the how. Here is your battle plan for the first week of January. First, the targets. We are sitting at $71.47. Target 1 is 75. If the pension funds enter aggressively on Friday, we should clear $75 within 48 hours. This confirms the breakout. Target 2 is 83. This is the previous high, the scene of the crime. The market loves to test old highs. Target 3 is triple digits. If we clear $83, there is no structural resistance between $83 and $100. It is a vacuum. The price could move from 80 to 100 faster than it moved from 20 to 30. Do not be surprised if we see a parabolic move in Q1. Do not sell into the first spike. Second, the exit strategy. This is the most important part. Buying is easy. Selling is hard. Most investors become cultists. They fall in love with the asset and ride it all the way up and all the way back down. You are not a cultist. You are a sniper. Your goal is to increase your purchasing power, not to collect digital zeros. So, when do you sell? You do not sell for dollars. Dollars are the problem. You sell for gold, land, or cash flow. We use the gold to silver ratio as our GPS. Right now, the ratio is roughly 60.1. It takes 60 ounces of silver to buy 1 ounce of gold. Here is the plan. When the ratio hits 40.1, you pay attention. The easy money is made. When the ratio hits 30.1, you scale out 20%. You trade the high-risk asset, silver, for the no-risk asset, gold. When the ratio hits 15.1, you exit completely. You buy a farm, an apartment building, or swap it all for gold. Write this down. 15 to 1. That is the finish line. Third, the warning. We are about to enter a mania. You are going to see friends who laughed at you suddenly asking how to buy silver. You will see makeup channels talking about commodities. This is the shoeshine boy indicator. When this happens, you will feel like a genius. You will be tempted to use leverage. You will want to borrow against your house to buy more. Do not do it. In a mania, silver can drop 20% in a single day and still be in an uptrend. If you are leveraged, you get wiped out. If you are physical, you just blink. Stay unleveraged. Stay physical. Stay sane. The verdict, 2025 was the warm-up. 2026 is the main event. We have the perfect storm. Industrial scarcity, institutional FOMO, and banks flipping long. The governments tried to stop it. They failed. Now the market takes over. Tonight at 6 p.m., the bell rings. Watch for the gap up. Watch for the volume. You have done the work. You are prepared. Now, all you have to do is execute. Comment 15 to 1 so I know you are playing to win. Happy New Year. Keep stacking, and I will see you on the other side of the open.